Peter went from bullish to mildly bullish stance on credit with the view that credit is in purgatory. Mildly bullish. Why'd you change?
One, we had such a good rally that a lot of the cheapness is over, so I think we've got to be a little bit more careful here. But I'm still sticking to, we've called 2019 the year of the debt diet. And by that I mean this is really a year that corporations are going to focus on their debt, and they're going to remain cautious about how much debt they take on. So you're seeing deleveraging. You're seeing companies like Anheuser-Busch. When they issued a lot of bonds, they took a lot of bonds out of the market. So I think we're not going to see this prevalence of debt. We're going to see companies focus on their balance sheet, and that will actually be good for stock price, and that's why they're doing it.
How much of this depends on what the Fed's up to? Because it's changed its mind, as I noticed.
Well, we're still seeing, like Peter said, a ton of refinancing activity and deleveraging activities. Verizon over the weekend announced a new tender offer. We saw with earnings, AT&T, this is like the most stockholder-friendly company out there, announcing that, yes, we've increased the dividend for a 35th consecutive year, but we're also making debt reduction the top priority. GE as well, we all saw that one coming. So I think what Peter's saying, this is right, and this is absolutely going to be a massive focus for companies this year.
So I was struck by some articles on Bloomberg talking about the hung loans in the market, so banks being stuck with loans they couldn't offload, and they had a issue below par to try and do that, price below par to do that. Is that a short-term trend, or is that like something to come and we need to pay attention to?
Well, I think when people talk about how loans are still a point of concern in the credit markets, and there is such a strong risk-on sentiment right now, but people still get to excuse my language, get still hung up on loans. And this is really where you're seeing that the banks are still having difficulty getting these loans off their balance sheets. These were loans that were originated back in November, December, and now we're having difficulty still getting them off, even with better terms and better pricing. So I don't think the risk sentiment has totally eased all concerns about leveraged loans yet.
So Peter, if this is the year of debt reduction for corporations, they're going to really clean up their balance sheets, or at least make them stronger. What does that say about debt versus equity? Because as a practical matter, that means there's less money to distribute to shareholders, to equity shareholders, right? That suggests you should be buying bonds and getting out of equity.
I think you've got to be a little bit cautious on the equity because, again, especially without a trade deal, we're going to see some headwinds for equities. You're not going to see as much balance sheet activity to pay for dividends or pay stock buybacks. It's going to be very company specific. It's one reason we've actually liked triple B bonds. I would say on single A bonds, that's probably where you could still see some leveraging activity for which would be beneficial to the equities. And then weirdly enough, I think double B bonds are a little bit overdone because they're the highest quality and safest part of the high yield market. So when this money comes to the high yield market and it's been flooding in, as I think last week was one of the biggest weeks of inflows on record, a lot of it goes to double Bs because people are cautious, so they buy that, and double B looks expensive to triple B now.